starting with the new chapter called cost of capital. First of all, having a discussion say with respect to the learning points that we have in this chapter. Dear students, name of the chapter is cost of capital. What do we understand with the term capital? The term capital stands for funds, and we are going to have understanding how to calculate the cost in respect of these funds. Cost of capital, capital means funds, and we are going to understand how to make the calculation of the cost in respect of these funds. Everybody is requested to pay attention. We can say something like this. A company is raising funds from the different sources of the finance. Those sources of the finance include equity share capital, preferential capital, debentures, loan. There is reinvestment of the earning in the business. Like that, so these are the different sources from which we have the funds which is invested in the business. It is invested in the fixed asset. It is invested in the trade investment, and it is invested in working capital. So these are the different, like the investment that say we make in the business. Whatever the investment that say we make, from that say we should be able to generate return. From that say we should be able to generate the return in order to give return to these fund providers. We understand that say the equity dividend is required to be given to equity shareholders. It is not mandatory, however it is implied to give return because anybody would invest only for the purpose of getting return. Preference shareholders are provided with the preference dividend. Debenture holders are given interest. For the loan, again we are giving interest, and so on. So basically, we want to know, listen carefully, we want to know what is the cost of these funds. Whatever the cost that we have for these funds, that is the minimum rate at which we have to earn from the business. If at all we are not able to earn, say at least that rate at which say we will be able to give return to all fund providers, we can say that we will not be able to say justify the business. We will not be able to give return to all fund providers. So what we are going to do, friends, listen carefully. Initially we are going to have understanding how to make the calculation of the cost of debt financing, how to make the calculation of the cost of preferential capital financing, cost of equity financing, cost of term loan, and so on. We are going to have understanding say of the cost of individual source of finance. Afterwards we will make the calculation of weighted average cost of capital, or we understand that say we are going to make the calculation of overall cost of capital, that is indicating what is that single rate at which we are supposed to earn so that we will be able to give return to all fund providers. I repeat that, say we are going to understand what is that single rate at which we are supposed to earn from the business in order to give return to all my fund providers. And that is what say we understand is cost of capital. Capital means all this, that is the funds. This is what say we are going to have the learning part of the chapter. Head on heading learning point of chapter. In the write down, first point, a company is raising funds from different sources of finance. And it is invested in the business. Second point, whatever the source from which funds have been raised, comma, they are supposed to be given return. Full stop. In this chapter, we are going to learn what is the minimum rate at which the company is supposed to earn so that return can be given to all fund providers. So that return can be given to all fund providers. Full stop. Third point, we are going to compute A, cost of individual source of finance, B, weighted average or overall cost of capital. To know a single rate at which company should earn to give return to all fund providers. Full stop. Now friends, apart from this, as I told you, we are going to understand certain concepts related to the financial planning. What does that mean? I give you some explanation to you like this. We will be provided with a set of the information in which we will be provided that which financial plan is supposed to be selected based on the earning per share. In a way that say we are going to, let us say, make investment in a project for an amount of rupees 10 lakhs. Now those 10 lakh rupees of the funds can be financed either with equity or with the combination of the debt and equity, or with the combination of the debt and, that is the equity and preference, or it is equity, preference and debentures. Let us say that say we would be provided with say some information like this. So among all these financial plan options, we are going to have the understanding that say which financing plan option should be selected for the purpose of maximization of the earning per share. This is the learning point that we are going to have additionally over here. So selection of the financial plan, apart from that, so there will be a concept which is given a name as financial break-even point. There is a concept called financial indifference point. These are say certain, so the concept that say we are going to learn additionally. So let us answer the question, that is read on further learning points. Fourth point. In this chapter, we are going to learn in this chapter we are going to learn, read on A, selection of financial plan. B, calculation of earning per share or market price of share for each financial plan. C, calculation of financial break-even point calculation of financial indifference point. And such other points. So friends, we are going to have understanding of certain calculations with respect to the financial plan. That is what we are going to have understanding over here. We are going to understand selection of the financial plan, calculation of the EPS, MPS. There is absolutely a new point called financial break-even point. Again, a new point called financial indifference point. This is what we are going to learn. Let us see the next question. X Limited is considering acceptance of a project which requires an amount of the investment rupees 3 lakhs. So information is given that say we want to make investment in a project and it requires investment of 3 lakhs. It is considering financing of the proposal by either of the following plans. So in order to make investment, we are considering say one of the following plans. First plan is say we'll go for the entire equity share capital financing 3 lakhs. The second is say the amount of the 3 lakhs will be financed partially with equity shares, partially with debentures and partially with preference shares. 1,50,000 equity shares, 50,000 preference shares, and 1 lakh of debentures. The rate of interest offered to the debenture holders is 10%. The rate of preference dividend 15%. Income tax rate is 40%. In case of equity shares, issue price is rupees 10. So we have been provided indirectly that if at all we go with the first plan, we are going to issue 30,000 equity shares, and in case of the second plan, we are going to issue 15,000 equity shares. You are required to calculate earning per share EPS for each financial plan if expected EBIT stands for earning before interest and taxes. It is also given a name as operating income, is 30,000 rupees and it is 1 lakh rupee. And with that said, the further questions are there. I request all of you to go through the question up to the first part of the question only. Let us have understanding that what is a question. Everybody is requested to pay attention. The question is providing that we are considering plan 1, plan 2 to finance an amount of rupees 3 lakhs. It is equity share capital, preference share capital and debentures. Amount of the equity share capital in the first case is 3 lakhs. No preference share capital, no debentures. Dear students, it is given a technical name as it is an unlevered financial plan. The term unlevered stands for no outsiders financing. Plan 2, 1,50,000 is equity, 50,000 is preferential capital and 1 lakh rupees of the debentures. That is the way, so we are going to have the financing of this 3 lakhs for the first option and 3 lakhs in the second option. Like that information is given. Informally, I am having a discussion first of all. Number of equity shares. That is supposed to be issued in the first case would be 30,000 and in the second case it is 15,000. So it is 3 lakhs divided by 10. 1,50,000 again divided by 10. This is the way number of equity shares are required to be issued in both the cases. The question says that say which financial plan you will adopt if expected EBIT is 30,000 and if expected EBIT is, you are required to calculate the earning per share. No decision is there. You are required to calculate the earning per share. If expected EBIT is 30,000 and you have selected first financial plan. If expected EBIT is 30,000 and you have selected second financial plan. Similarly, say for 1 lakh you are required to make the calculation. So basically you are required to make 4 calculations in the first part of the question. Suppose you selected the first financial plan and you got the EBIT 30,000. You selected the second financial plan and EBIT is 30,000. Similarly, say for 1 lakh. This is what we are required to do in the first part of the question. Let us answer the question. Working note number 1. Calculation of number of equity shares to be issued. Return amount divided by issue price. So it is plan 1 and it is plan 2. Plan 1 is 3 lakhs and plan 2 is 1,50,000. What is the issue price? It is 10. Number of equity shares are 30,000. And number of shares are 15,000. This is a way number of equity shares could be to be calculated. Next, calculation of earning per share for each financial plan, comma, for each level of EBIT. There are two levels of EBIT, 30,000 and 1 lakh, and for each of them we are required to compute EPS. This is the way we are required to make the calculation of answer. I request you to give answer in the chat box. What would be the EPS of the first financial plan if expected EBIT is 30,000? Write answer in the chat box. What would be the EPS of the first financial plan if expected EBIT is 30,000? So friends, we have to start the working like this. EBIT, it is 30,000 less interest. In case of plan 1, it is 0. Why? Because it is unlevered plan. I request all of you to write down answer along with me. Earning before taxes, that is 30,000. Income tax rate is 40%. So earning after taxes is 60%. That is 18,000. Less preference dividend. Again, preference dividend is 0. So earning available to equity shareholders, 18,000. Number of equity shares, for plan 1, number of equity shares are 30,000. So that will give us EPS. It is 0.60. It is 18,000 divided by 30,000. That is the way the EPS is calculated, 60 paise. This is for plan 1. I request you to do for plan 2 and put your answer in the chat box. Plan 2 and EBIT 30,000. So again EBIT will be 30,000, dear students. Second financial plan is levered financial plan, in which the outsiders financing is introduced. Amount of the debentures is 1 lakh and the rate of interest is provided as 10%. So the amount of the interest is 10,000. EBIT minus interest, EBIT is 20,000. Income tax rate is 40%. So earning after taxes is 60%. That comes to 12,000. Preference share capital is 50,000. Rate of preference dividend is 15%. So that comes to 7,500. Then earning available to equity shareholders, 4,500. Number of equity shares 15,000. Here is 15,000. So earning per share is 0.30. It is 4,500 divided by 15,000. Like that the answer is calculated. Please take down answer. For 1 lakh and first financial plan, please put your answer in the chat box. So again we will have working like this. This is 1 lakh rupee. Amount of the interest is 0. EBT is 1 lakh. EAT is 60,000. Amount of the preference dividend is 0. Earning available to equity shareholders 60,000. Number of equity shares are 30,000. And EPS is 2. That is 60,000 rupees divided by 30,000 shares. This is the way the answer is found. For 1 lakh 2, answer is like this. 1 lakh, interest same 10,000, EBT 90,000, EAT 54,000, preference dividend 7,500. So 54,000 minus 7,500 is 46,500. Divided by number of equity shares 15,000. So that gives the EPS of 3 rupee 10 paise. 46,500 upon 15,000. Please write down answer. So friends, in the first part of the question, we are required to compute earning per share for each of the financial plan, for each of the level of the EBIT. That is what we are supposed to calculate in the first part of the question. Means if you select the first financial plan and you end up with the EBIT of 30,000, then what will happen? You select the second financial plan and you end up with the EBIT of 30,000. What is EPS? And same is the case with 1 lakh. Second part of the question, you are required to calculate in the financial indifference point between financial plan 1 and financial plan 2. Let us have understanding that say how we are supposed to calculate the second part of the question answer and what does it indicate. Everybody is requested to pay attention. Let me explain you. Do not write anything. Financial break-even point is indicating that level of EBIT at which earning per share of both financial plans will be same. So basically we are required to compute such level of the EBIT at which EPS of both the financial plans are same. That is the question. In order to explain the second part of the question, I take help of the first part of the figures. It is not necessary that say we should be having the answer of the first question. Only in that case say we can compute the answer for the second one. See what happens at say when the expected EBIT is 30,000, then first financial plan has EPS of 60 paise, this, and second financial plan has EPS of 30 paise. For expected EBIT of 1 lakh, first financial plan has EPS of 2 and second financial plan has EPS of 3.1. That is what you can see. So for expected EBIT 30,000, we can say, let's say the plan 1 is better than plan 2. For expected EBIT 1 lakh, we can say plan 2 is better than plan 1. And we are supposed to calculate in the second part of the question, what must be the level of the EBIT at which both the financial plans will have the same earning per share. So at that point of time, you are indifferent whether to select the first financial plan or to select the second financial plan. And that is what say we are required to calculate say in the second part of the question. So let us have understanding how to calculate the answer. Everybody is requested to pay attention. First of all, I am writing the formula for EPS. I request all of you to pay attention. EPS is calculated as earning available to equity shareholders divided by number of equity shares. Earning available to equity shareholders is found as earning after taxes minus preference dividend. That is earning available to equity shareholders divided by number of equity shares will remain same. Earning after taxes is earning before taxes into 1 minus tax rate minus preference dividend is earning available to equity shareholders divided by number of equity shares. Earning before taxes is earning before interest and taxes minus interest, that is EBT, into 1 minus T is EAT minus preference dividend is earning available to equity shareholders divided by number of equity shares. This is what's the formula for the earning per share. The question says that so you're required to compute the financial indifference point. So I request all of you to write down answer along with me. Financial indifference point. In that write down EPS of the first financial plan is equal to EPS of the second financial plan. I hope that everybody is clear with the first equation that I have kept. I have explained to you that say the financial indifference point is indicating the level of the EBIT at which EPS is same. So the first unlevered financial plan EPS is equal to EPS of the second financial plan. How do we compute the EPS? EPS is found like this: earning before interest and taxes minus interest EBT into 1 minus T EAT minus preference dividend earning available to equity shareholders divided by number of equity shares of the first plan is equal to, on the opposite side, again EBIT minus interest EBT into 1 minus T EAT minus preference dividend is earning available to equity shareholders divided by number of equity shares of the second plan. Okay, we'll assign X variable to the EBIT. What is the interest amount in the first financial plan? 0. What is income tax rate? 40%. What is the preference dividend for the first financial plan? 0. How many equity shares are issued for the first financial plan? 30,000. On the opposite side, again X minus interest amount. What is the interest amount for the second financial plan? It is 1 lakh into 10 percentage, that is 10,000, into 1 minus income tax rate minus preference dividend 50,000 into 15 percentage, that comes to 7,500, whole divided by number of equity shares. How many equity shares? 15,000. This is the way, say we have a kind of equation to be kept. Now we will compute the excess balancing figure. So 15,000 is cancelled over here, 30,000 is cancelled over here, and this will be 2. X minus 0 is what? X. 1 minus 0.4 is what? 0.6. Whole divided by 2 is equal to X minus 10,000 into 1 minus 0.4 is 0.6 minus this is 7,500. Okay. Now this 2 is cancelled over here. 0.6 divided by 2 is 0.3. So the value will be 0.3x is equal to, listen carefully, 0.6 into x is 0.66. 0.6 into 10,000 is 6,000 minus 7,500. 6,000, 7,500 transferred on the opposite side, so it will become positive. So it is 6,000 plus 7,500 is equal to 0.3x is transferred on the opposite side, so it will become negative. So 0.66 minus 0.3x. 0.6 minus 0.3 is 0.3. 6,000 and 7,500, adding both of them, that is 13,500. So x is 13,500 divided by 0.3. That comes to 45,000. So 45,000 rupees is the level of the EBIT at which EPS of both the financial plan would be same. That is what we understand. Whatever this answer of 45,000 that we have computed, that can be cross verified. How can we cross verify? Let us have understanding. See over here, we can have the calculation of the EPS of both the financial plans at 45,000 rupees of the EBIT. See, we can say that's the plan 1 and plan 2. Okay, let us see that's both the plans. EBIT, first financial plan, it is 45,000. Interest 0. EBT 45,000. So 45,000 into 0.6, 27,000. There is no preference dividend. So earning available to equity shareholders 27,000. Number of equity shares 30,000. EPS is 90 paise. That is the way we can compute the EPS. For second financial plan, this is 45,000. 1 lakh into 10 percentage, 10,000. 35,000. 35,000 into 0.6, 21,000. Preference share capital is 50,000. Rate of preference dividend 15 percentage, 7,500. 21,000 minus 7,500. It is 13,500. Number of equity shares 15,000. So 13500 upon 15,000. 0.90. That is the way the EPS can be calculated. So EPS is 90 paise, and we can say that's the answer that we have computed is correct answer. The question says that calculate financial break-even point for each financial plan. What does it mean? It means that we are required to compute such level of the EBIT. We are required to compute such level of EBIT at which EPS is 0 for each of the financial plan. This third part of the question is required to be calculated for the individual financial plan, for plan 1 as well as plan 2. So let us answer the third question. Financial break-even point. In that write down, it means such level of EBIT at which EPS will be 0. Full stop. It is calculated as under. So friends, it is calculated by using a formula like this. Interest plus preference dividend divided by 1 minus tax rate. This is the way it is supposed to be found. And in a simple way, we can say that the break-even point means there is a situation of no profit, no loss. That is a normal concept that we have even in the costing. The same concept is applicable over here. It is the level of the EBIT at which EPS is 0. Now the formula is having a kind of explanation like this, only for understanding purpose. We know that the EPS is equal to EBIT minus interest, that is EBT, into 1 minus T is EAT, minus preference dividend is earning available to equity shareholders divided by number of equity shares. We know that the answer of this equation is required to be found in terms of EBIT in such a way so that the EPS is 0. So I take EPS 0 into N is equal to EBIT minus interest into 1 minus T minus preference dividend. Now anything into 0 will become 0. So this answer will become 0. So 0 plus preference dividend. Because we understand that over here the preference dividend is negative. It is transferred on the opposite side, it will become positive. Is equal to EBIT minus interest into 1 minus tax rate. Anything plus 0 will remain the same, preference dividend. So it is the preference dividend divided by 1 minus tax rate. See, understand that over here it is in the multiplication. It will be transferred on the opposite side, so it goes in the division. Is equal to EBIT minus interest interest is transferred on the opposite side. So EBIT is equal to preference dividend divided by 1 minus tax rate, whatever the answer that we have, plus interest. That is the way we make the computation of the answer. Let's say this is what's at the level of the EBIT at which EPS is 0, and that is financial break-even point. Preference dividend divided by 1 minus T plus interest. So we can say that over here there are two financial plans for which we are required to do answer. Financial plan 1 and financial plan 2. Basically friends, as far as the first financial plan is concerned, it is an unlevered financial plan, ungeared financial plan. So it means that say there is like we can say that say there are no outsiders financing. So in that case the financial break-even point will be 0 because you don't have a commitment to outsider. What is the interest amount? 0. What is preference dividend? 0. So 0 divided by anything, that value will be 0, and 0 plus 0 is 0. So in the first case it is very simple to calculate. In the second case you have to do working like this. Amount of interest is 10,000. Amount of preference dividend is 7,500 divided by 1 minus tax rate. So it is 10,000 plus 7,500 divided by 0.6. So what will happen? It is 10,000 plus 7,500 divided by 0.6. The answer is 12,500. That comes to 22,500. This is the way the answer is calculated. And you can very well understand 22,500 EBIT minus interest of 10,000. So EBIT is 12,500 minus like 40 percentage, because so that is the tax amount. So we'll have the earning after tax is 7,500 minus preference dividend 7,500. So we have earning available to equity shareholders 0 divided by number of equity shares are 15,000, and the answer would be 0. This is the way we can even have a cross verification of the answer. Fourth question. Based on expected EBIT, which financial plan should be selected? That is a question. See, there are two levels of EBIT provided to us in the example. One is 30,000 and another is 1 lakh. In both of them, that is, in both the cases, which financial plan to be selected is a question. So, based on the working that we already have made, for 30,000 rupees of the EBIT, first financial plan is better than the second. And for 1 lakh rupee of the EBIT, second financial plan is better than the first. So answer for fourth question, write down. For expected EBIT, rupees 30,000, plan 1 should be selected. Comma, for expected EBIT, rupees 1 lakh, plan 2 should be selected. Full stop. That is what we understand. Now my question to all of you is this, only I'm having some discussion. Suppose expected EBIT is 40,000. Which financial plan is better? One or two? My next question, if expected EBIT is 50,000, which financial plan is better? One or two? So friends, over here, we understand that say, quickly we can answer these questions. Let's say for 40,000 we can select the first, and for 50,000 we can select the second one. How we can answer so quickly? We can answer these questions very quickly because we have computed financial indifference point. Yes. So we can say something like this. Listen me carefully. Expected EBIT is greater than 45,000. Then in that case we should select plan 2. Why? Because the plan 2 has more, that is will have more EPS than first EPS, first plan. If expected EBIT is less than 45,000, the company should select plan 1, and at 45,000 the company is indifferent. This is what we understand. Let me give explanation of this to you. Everybody is requested to pay proper attention to understand. Dear students, we have computed that say the financial indifference point is 45,000. What does that mean? It means that that is the level of the EBIT at which both the financial plans will have same earning per share. That is 90 paise, 90 paise, that we have computed even though it was not asked. Logically, we understand that say when you are expecting the operating income less than the indifference point, you should select a financial plan which has lower financial charges and it will have more EPS. And when you are expecting the EBIT more than the indifference point, then in that case you should select a financial plan which has more financial charges. Why? Because in that case you have a good amount of the income and you can introduce leverage in the business. You can introduce the fixed commitment sources of the finance in the business. So in that case you should select the second plan instead of first. This is the reason we understand that say we can take immediate decision looking to the EBIT and comparing the same with the financial indifference point, that which plan should be selected. This is what we understand say with this discussion. So over here friends, on x-axis I am taking EBIT, on y-axis I am taking earning per share. Everybody is requested to pay attention. This is the financial plan 1. And this is the financial plan 2. Now, basically we understand that the financial plan 1 starts from 0 and financial plan 2 starts from 22,500. Why? Because it has the financial break-even point 22,500. There is an intersection between 1 and 2. Intersection between 1 and 2 is indicating that say what is the financial indifference point? What is the point at which you are indifferent between both the financial plans? That is what we understand. This is the first financial plan. The intersection between 1 and 2 is indicating the level of the EBIT at which EPS of both the financial plans are same. That is 45,000 rupees in this example. At that point of time, EPS is same 0.90. Now, basically you are required to have understanding of the diagram in this way. See, for any EBIT less than 45,000, we can see that say plan 1 is better than plan 2. See, this is you have to understand. You draw any other line, you will find that plan 2, so plan 1 is better than plan 2, and beyond 45,000 you will observe that the plan 2 is better than plan 1. Plan 2 is better than plan 1. That is what we understand. In that case, you should select the second financial plan instead of first. You should select second financial plan instead of first. That is what we understand.